financial help from financial planner at Envision Financial. Luke's with you, bearing up with the heat.
Mate, it's a little toasty out there. I'm not built for hot weather.
Aren't you really?
I'm not really.
Okay.
No.
You can turn the aircon up in your Mini.
Yeah, well, that's it. You can't get that high enough.
25 to 5. If you have a question, this is your opportunity. If you want to see their offices, they're at 4452 Townsend Street, upstairs at the end of Townsend Street in Phillip. You can call their office and make an appointment, no obligation, first time round, 62604746. Now, you've got me stumped with this one. 49, sorry, 49. You've got me stumped with this one. Last week I was happy because I knew what I was talking about.
Right.
But you're going to teach us all now about ETF.
ETFs.
What are ETFs?
So an ETF stands for Exchange Traded Fund.
Right, you still got me. Elaborate.
Okay, so we all know what a managed fund is.
Yep.
It's a collection of assets that's provided by an investment house. An ETF is a collection of assets that targets a specific sector. So, for example, if we wanted to buy the biggest 200 companies on the Australian Stock Exchange, we can buy that index through a single vehicle, which is an exchange traded fund. Now we can take that a step further because, as I said before, we're targeting a specific index. So you could say, I want to buy the biggest 20 companies on the Australian Stock Exchange, the biggest 50 companies. I want to buy companies in a healthcare sector. So you can target a broad, diversified holding of multiple companies in a specific sector. So it's an exchange traded fund. So it's listed like a share, trades like a share on the stock exchange. So you need a trading account or a brokerage account to buy it. It is very well diversified. So you can get a passive exposure, which means you would have, in that example, the largest 200 companies in the ASX. So you'd own a little bit of each of those.
Scatter it. Right.
So it's a very good way to diversify an exposure. They are very, 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 very cost effective. And I stress the very, very. Because a standard managed fund, depending on the sector, could range in internal cost ratio, or ICR, which we touched on last week, which is the cost of the provider giving you the opportunity to invest in ABC.
Right.
A managed fund could cost 0.7 to 2%, depending on the provider. An exchange traded fund or ETF could cost 0.07% to, generally they cap out at about 0.4. So they can be, in some instances, more than 50% cheaper than a standard managed fund.
Rather than putting all your eggs in one basket.
Well, it comes back to the product, as we've said in the past. You don't need a Ferrari to deliver bread. If you're looking for a very cost-effective way of diversifying your assets, an exchange-traded fund is a really good way to get that diversification.
So how much do I have to get one of these things?
Well, you can generally buy them in minimum allocations of $1,000.
Oh, so you
just
have
like
to be multi-millionaire?
No, not at all.
You know, that woman in Sydney won $100 million.
No, she could probably buy a couple, but no, you don't need to. So they're a very good way for lower account balances or first-time investors.
I was going to say, if you've never done anything.
Exactly. So rather than thinking, you're Warren Buffett and picking an individual stock, you can use an exchange-traded fund or ETF to get a broad diversification in different areas.
Is it blue chip stuff?
Well, as I say, it depends on what you want to tailor it to.
So you can actually select the stuff?
Correct, that's right. There are many, many, many providers in the market, and there are many ways of gaining different exposures to different sectors.
Why haven't we heard about this?
Well, these aren't new. They've become more prevalent post the GFC because people started to look at their costs, their fees and their charges and realise that standard managed funds, in a lot of instances, were taking the cream off the top, if you like. So they've become more and more prevalent in the retail market. In the investment world, we've been using these things for 10 or 15 years.
Okay. How many companies can you dip your toe into?
Oh, look, you can...
So say you want to buy health products.
Yeah, so you could go out and buy an ETF that targets US health sector companies.
Right.
You could go out and buy fixed interest ETF that targets Europe. Now, you may or may not want to do that given the state of the European economy. So it's always about starting with why, coming back to saying, how do I feel about risk, and then finding something that will give you a broad dispersion of assets in a specific sector.
Okay. And that you can do that for overseas markets too?
Yeah, look, you can go out and buy the S&P 500 index. You can buy a physical replication of that through an individual ETF, and it costs 0.07%.
Right.
So that is super, super cheap, and you're getting exposure to one of the largest indices in the world.
Are you minimising risk by doing this?
Very much so. Any investment has risk, but it's a very good way of being able to diversify what your money's invested in by having a broad allocation to an individual market.
And you can say, I want this, 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 and this.
Yeah, you can go out and combine them as part of a portfolio. And a little bit later in the show, we're going to talk about how you can use them and how they fit into a portfolio. But they're a very good way of getting cost-effective diversification in a sector that you have selected.
All right, so I could go to you and say, I want this.
You could come to me and say, I want to buy the ASX 200 index, which is the largest 200 companies.
The whole ASX 200?
Yep.
Really?
In one product at 0.18%.
What, for $1,000?
And you could spend $1,000 on it. Yep.
That's very thin, though, across 200, isn't it?
Well, the investments are always thin relevant to the capital value that you put into them.
Yeah.
It's more about saying, what am I working with, and how do I feel about risk, and am I maintaining a suitable amount of risk for what I'm investing in?
And I like your point, Luke Smith, about if you're a first timer, this is a good way to
look.
feel
This
the
is
market out.
exactly. Look, the market's a little bit up and a little bit down at the moment, and there are a number of factors that are weighing on investment houses and different indices. But it's a very good way of putting a toe in the water and building a position over time.
Yeah.
You can get very good diversification for a very small spend, and it's very cost effective, relevant to other areas or investment options.
If you bought the ASX 200, the top 200,
Yep.
gee, a lot of companies in there.
Yeah, but that's, that may be a way of you strategically saying that's my diversification play, and then around that I'm going to target some specific things that may be a little bit more sexy that are in line with your risk profile. So they're a good combination tool.
But if you've got the ASX 200, some go up, some go down, some
Correct.
stay stable.
Yep, that's right.
You don't have to read a lot.
Well, potentially. Or you put that in place and say, well, that's my spread. Now I'll go and read about the ones I want to take a direct exposure in.
Okay.
So looking to try and stack this on top of each other as a strategy is really important. And the term we use in the office is strategy stacking. So we're trying to stack as many strategies as we can on top of each other that get you closer to where you want to go at a speed you're happy to drive at, to use that analogy we have in the past, to make sure that you're moving in the right direction.
If you don't know about the specific, I suppose, type you want, how do you find out if you want to buy the top 200 companies that make Band-Aids? How do you find out
Well,
these companies?
you wouldn't delve that far into it.
Right.
That's probably a little extreme.
Right.
But you could go out and say, well, I want to invest in the largest property companies in Australia.
Right.
And I want to buy the property index. I'd like to buy the Australian equity index. I'd like to buy the biggest 20. I might like to buy an exposure to the Japanese economy. I might like to buy an exposure to the largest 100 companies in the world. So there are lots of different ways, and you can make this as boring or as sexy as you want to make it,
Yeah.
but they're a vehicle that is out there that I think are very, very underutilised, and a lot of people don't seem to be aware that they're there. And I say every week, check what you're paying in your fees. Check your internal cost ratios. Have a look at what you hold in your portfolio. If you're paying more than 0.5% for your ICR costs, 0.5 to 0.7 across a diversified portfolio, pretty standard. If you're up over 1.5 to 2, then you really need to have a look, because you're paying potentially 1%. And as we said last week, 1% on, or 0.5% on $500,000 super fund, it's $2,500 a year, it's 25 grand over 10, just because you didn't look at what's under the hood.
If you dive into this one and you get a particular issue or a particular lot, can you expand on that, or is it?
Yeah, you can buy
buy 20 at the
exposures.
top of them, and then it can go to 30 or 40 or 50.
Well, you can put them together and stack them as much as you want. So you might say, give me the ASX 200. There's my broad exposure. Give me a dabble in the property index that buys the biggest property companies in Australia. You might say, well, then give me an exposure to America. I'd like to hold Google, Microsoft, Amazon, Alphabet, all in one product. Okay, then you might buy a specific index in America. That'll give you a broad exposure to that, rather than trying to stock pick and only have 2 or 3 eggs in your basket.
Yeah.
With broader diversification comes a way to limit the risk, limit the volatility, and then you can take your specific picks around it and build a diversified
So you'd
portfolio.
never think, would you, Luke, that you could buy a part of Google? I mean, Google
Oh,
is
exactly.
expensive.
And this comes back to understanding, well, where do they sit in the index,
Yeah.
and what do I want to target? So you could go out today and buy the ASX 20 biggest companies, and you'll get some resources, you'll get some banks, you get some healthcare. You might say, well, if the biggest 20 companies in the country go under, what chance have we got? Now that might give you a sense of comfort.
So is this
that may be
utilised a lot?
appropriate.
Is it for
Yeah, look,
everyday investors like me?
Yeah, look, you should be.
Yeah.
And I guess the point of this discussion is to make you aware of that,
Yeah.
to make you think, well, okay, what else is out there? Because too often I say to people, do you know what an ETF is? And they go, is that, no. So,
you never think about that. You think about, I'll just buy 100 shares in this, 1,000 shares in that one, 200 shares in that, because they look like good companies.
Yeah.
But here you can buy the whole ASX 200.
yeah, you can
even
spread your
buy
risk.
it overseas as well.
Yeah, correct, that's right. So it always comes back to, why am I doing it? What's my risk profile?
Yeah.
How fast do I want to drive the car in the 100 zone? Do I want to do 40? Do I want to do 160? And am I happy to take the risk that comes with that?
It'd be pretty exciting to have the ASX 200.
Well, look, it's something that most people catch on the news at night.
Yeah.
When just before the weather they say, oh, and the ASX 200 went up 9 points today, down 15 points, or anywhere in between. It's a good way to people to be engaged, and especially for young people. It's a good way to get a first exposure to keeping an eye on something, watching something, averaging into something, and doing it with a little amount of money. Okay, so $1,000 onwards from an exposure perspective. But then you can always save into them and buy a few more, and buy a few more, because they're not costing you a lot to build that over time. So really good for savings plans and for younger people.
And you're quite right, Luke, if the ASX 200 tumbles, well, we're all in strife.
Well, it's just a measure of what could it be worth.
Yeah, that's
exactly right.
You can talk to Luke Smith, financial planner at Envision Financial. If you'd like to make a booking, you can do that there in Townsend Street, Phillip, on 62604749. First visit, no obligation. We'll go around these ETFs and see how we can get them into our portfolio. Next on Canberra Live, it's 14 to 4. It's 11 to 5. Luke Smith, financial planner at Envision Financial. 62604749 is his office number. But if you've got a question now on the top of your head you'd like to ask him, you can do that on 6255 1206. We're talking about exchange traded fund. I like the little word though, ETF. That's the best thing to do. How can I get it into my portfolio? I've got a portfolio already, all right?
Yep.
I've got a number of shares, had them for years. Can I include this in them?
Yeah, look, it's definitely something that is a really good building block. So an ETF is a very good way of making sure that you have a suitable amount of diversification and you can have it complement existing assets. So if you already hold the biggest 20 companies on the ASX directly, then maybe you take a broader view. Maybe you take an offshore view. Maybe you take a fixed interest allocation. Maybe you take a property allocation and you use it to complement the active funds in your portfolio, and it provides more of a passive profile. So what I mean by that is it will replicate the index. It obviously won't outperform the index because it is the index. That's effectively.
Right. Yeah.
So we have actively managed funds in specific sectors to create what we call alpha, or outperformance relative to the broader market. Whereas an ETF is a very good passive play to be able to say, well, I'm going to stick to my knitting and I'm not going to have all of the assets in my portfolio being high risk. These may be more defensive or more diversified. As I said earlier, you could have the ASX 200 and then you could go out and pick 5 or 6 of your favourites if that's what you like. You could also use it to say, here's an exposure to the ASX 300. So we're getting a little broader now. And then I've got some actively managed funds that target healthcare, that target banking, that target geared equities, that target the largest 100 companies in America, Europe, Japan. So they're a very good way to complement existing assets and further diversify your portfolio in a cost-effective manner, and you can control where and how very clearly with very good levels of transparency what's in there at any one point in time.
We buy a share because we want something.
Yep.
It's very, very nice to see the shares go up or down.
Correct.
But in the mail, we want to get a check every now and then.
Yep, correct.
How does this ETF work in that way?
So in relation to income, depending on what you buy and the sector you target, will depend on the outcome that you get. If we buy a growth asset, i.e. we buy an offshore investment, they provide more capital growth and less income. If we buy the ASX 20 biggest companies, then you'll get a very solid dividend profile, just like you would if you held those direct shares. So looking again at why you're buying it will have a direct outcome on the income that you receive and the capital growth that you achieve over time, because the indice will replicate or behave in a similar manner or exactly the same manner as the underlying share. Now you could also go out and say, well, I want to buy a high yielding ETF, and that will hold a collection of high dividend paying companies, because that may be something that you want to complement the growth portion of your portfolio.
Yeah.
So if you're in retirement phase and you want a high level of dividend, then these are a really good way to try and build in not only good dividends, but you also benefit from all of the franking credits issued by the companies in the ETF. So there's significant tax benefit available for people as well.
I was going to ask tax too,
Yep.
because
So
we want to make sure that we're going to be okay.
correct. So as part of a portfolio, if we put our retirement hat on, and we know that a pension in retirement is generally a tax-free structure,
Yeah.
you can generate franking credits from an ETF just like you could by holding a Commonwealth Bank share, for example. Okay, so we're getting the dividends from those underlying shares paid to us like we would if we held the shares. We're getting the franking credits that are paid by the companies that we invest in, and that's the tax paid by the respective companies. We get those credits. So you don't miss out on anything by having an ETF. It's about understanding where you want to invest and what the outcome is. Do I want growth? Do I want income? Do I want foreign? Do I want Japan? Do I want Europe? Do I want America? Do I want anything in between?
Now, going to go political on you. You ready for this?
Hit me.
What happens if Labor gets in about these franking credits?
Oh, look, let's flip a coin. Hopefully common sense will prevail, and the greater good of the Australian public would be at the forethought of any sort of decision making, because I think it's a vital part of people's retirement planning. I think it's a vital part of the reason that they invest in local companies and support local businesses, which is very, very important, which was why and how it was created many, many years ago, to incentivise people to vote or to buy local companies. I think it would be a terrible shame if one party looked to try and remove those, to try and use them for something else, because with every likelihood there will be strategies created by people in the finance industry to prevent the amount of money going to him if he was to think he was going to generate revenue. So,
and most over 65, a lot haven't even retired yet, but they're looking for their retirement now, and they want to get buy shares. So these ETFs would be a good way to do it, wouldn't it?
it is.
If you've never touched the share market
Look,
before.
it's a very good way to put a toe in the market, build a position, and
Get a little bit of return.
Yeah, look, it's always about trying to say, well, why am I doing it? What can I get? And how can I do it cost effective? Cheap, in a lot of people's eyes, is good. Now, it may not be, but is the key driver for a lot of decisions that people make.
Yeah.
And this will tick that box. If you're looking for a cheap option to give you a good exposure, it's definitely something.
And if you've never done it before and you're looking for retirement in 5 or 10 years, this is a good way to keep
Look, it's a good thing for people accumulating. It's a good thing that people are retired. It is really, really good.
Where can I go wrong?
Well, I guess not understanding your risk profile.
Yeah.
So buying something that's riskier than you can stomach, buying into sectors that are very volatile or more volatile than others, and also then not understanding the implications of what you're doing.
Yeah.
Or buying it in the wrong structure is another one.
Yeah, that's true.
But generally speaking, you get some really, really good outcomes with a very, very cost-effective vehicle.
So our acronym for this week, Luke, is ETF. We'll go back to the start of our conversation. Also look at your fees and charges and costs.
Yeah, look, I think this is a key driver of, again, looking at that cost scenario. People should be aware of what's going on under the hood, and it is really, really, really important that people know what they're paying and what they're getting for what they're paying.
And have a bit of fun.
Well, just understand what's going on.
You know, have control of your money.
Yeah, look, it's there. If you want to learn more, you can go to our website, www.envisionfinancial.com.au. Click on the Knowledge Centre. You can subscribe there for free and get access to a whole library of information that can talk about these sorts of things. We've got written content, we've got videos, we've got animated videos. There's lots of information that you can delve into if you're the, information-driven type.
And he's on Facebook too, would you believe that? Envisionfinancial.com.au. If you want to make an appointment, as we've said over the last couple of weeks at the start of 2019, get your financial ducks in a line, and you can do that with Envision in Townsend Street in Phillip, 62604749. We'll see you in a week.
See you next week.